Hello, I'm Carolyn Herbert from the Finance News Network, and joining me from Ausbil to provide an update on the economic environment and its implications for the local market is Chief Economist Jim Chronis. Jim, welcome to FNN.
Thanks for having me.
Jim, can you start by giving us an update on how the economy is performing?
We at Ausbil have been expecting the economy for 2015 to be below trend. Trend is at 3.25%. The economy is now running at a pace of 2.5%. The drivers of growth to date have been private consumption, dwelling investment, a lower level of unemployment, which is supporting retail sales. Unfortunately, private business investment hasn't picked up to the degree that we would desire at this point of the cycle. So the economy will continue to grow at a below trend pace.
And what impact is the lower Aussie dollar having on business demand, manufacturing and the export sector?
In the last 12 months, the Australian dollar against the United States dollar has depreciated by 20%, and on a trade-weighted index, it has fallen by 15%. The first area that you'll see the benefits of the decline in the Australian dollar is in the business surveys. So the NAB business survey covering conditions and confidence for most of 2015 has risen and will continue to stay positive. The second area that we're seeing the immediate benefits of the lower dollar is in those sectors that are competing in the international environment. That includes tourism, education and business services. They are all seeing material increases in output for those sectors. And the unsung hero for the Australian economy is that services as a share of our exports is actually rising at a rapid rate since 2013 on the back of the fall in the Australian dollar. So we are becoming competitive on the world stage.
Now, with the RBA taking a wait and see approach with respect to further rate cuts, when do you think it's going to move again?
The hurdle for further rate cuts is high. For 2015, at the beginning of this year, we at Ausbil were expecting 2 rate cuts from 2.5% to 2% on the basis of non-mining investment not picking up. That's happened. Going forward, the currency has depreciated. It's a level of 72 cents against the US dollar. It is at a level that the Reserve Bank is comfortable with, and you are now starting to see export-sensitive sectors respond to the lower Australian dollar. So the cash rate can remain at this level for lower and for longer until December 2016. If we get a further deterioration in non-mining investment, which leads to a lower level of GDP, then the Reserve Bank has room to lower rates. But the hurdle is very, very high for them to cut.
Jim, taking a look overseas now, and what would you say are the major international macroeconomic factors that are affecting the outlook for markets at the moment?
Our outlook at Ausbil is one of optimism and continuing growth for the world economy. By region, the United States is recovering at a very, very rapid and robust pace. It's achieved its goals of full employment, inflation is coming back to 2%, and the US Federal Reserve is ready to tighten rates in the December quarter of this year. Europe is recovering. Last year it looked dreadful. This year it's recovering at a good pace of 1.5% to 2%. China is in transition. Growth rates of 8 or 9% will not return. The economy will transition from reliance on manufacturing and heavy industry and commodity intensive sectors to more services. So we're talking growth rates of 7 that will then go down to 6, that will then go down to 5, but we're talking this happening over the medium term, not immediately. So that's a positive environment to which the Australian economy, through its exports, is exposed to and will derive a benefit.
And finally, Jim, how do you expect local markets to react if the Fed decides not to hike rates in September?
The US Federal Reserve for this year has telegraphed well in advance that they want to tighten rates. And in the last few weeks, we've had members of the FOMC, including the chairperson, Janet Yellen, amplifying their intentions to tighten rates. We at Ausbil believe rates will be hiked by the December quarter of this year by 25 basis points. The market, based on the information that was released last week, has moved from a September tightening to a December tightening. The date of the tightening is, in our opinion, not relevant. What is relevant is when they do commence to tighten rates, that the final cash rate that the Federal Reserve will take the Fed funds rate to will be less than what is currently being priced into the markets, and it will be conducted over a longer time frame than it is what currently expected. So if they don't tighten rates in September, you will see a relief rally in all equity markets.
Jim Chronis, thank you for your insights.
It was a pleasure.